Okay, leverage ratios. So, we first is what the book calls a total debt ratio. I refer to it as the debt ratio. The total liabilities, or total assets minus total equity. Get to the point where I can. So, this total assets minus total equity. Remember your balance sheet equation. That's total liabilities. So for our imaginary corporation, that's the that's 3,588,000 minus 2,591 uh, million of total equity. So the we divide that by total assets, and we get 0.28 times. So that means our debt ratio the is 28%. So 28% of the company's assets are financed with debt. So the rest would be equity. So 72%. Next is the debt to equity ratio. So this is total debt divided by total equity, or also total liabilities. So this is would be our so we take our 28 cents of debt, total debt, divided by the equity portion. So that's a 28% divided by the 70% gives us a debt to equity ratio of 0.38 times. The we can also have the equity multiplier, which will come up in the DuPont identity. So the basic formula for the DuPont identity is total assets minus total equity, but it can also be calculated as one plus the debt to equity ratio. Most people would do the debt. The book does D-E, and they actually go back and forth, but most people would denote the debt to equity ratio as D/E. So just a note. So anyway, either way, you should calculate an equity multiplier of 1.38 times. So this would be the one plus the equity ratio, which is actually should be 385. So for 1.385. But if you divided the 3,588 divided by of total assets minus the equity of 2,591, you should also get 1.385. So next we move on to coverage ratios. First is times interest earned. The times interest earned is earnings before interest and taxes divided by interest. So for our imaginary corporation, EBIT, this comes from the income statement. Both of these do. EBIT is 600 million. Our interest is 141 million. So that's 4.626 times. So the to analyze EBIT, I mean not EBIT, times interest earned, we'd either want to compare year over year, this year to last year, or compare our company to one of its peers to get an idea of how effectively it's usually meeting its debt service requirements. Next, we have cash coverage. So the EBIT plus depreciation and any amortization, divided by interest. So we're adding back those non-cash items. So that so our EBIT was just like before, 600 million plus two 276 million of depreciation amortization, so that's 6.22 times. So it appears that the company is should be able to meet its debt requirements or debt service requirements. Next item is inventory ratios or turnover ratios. The inventory turnover is simply the cost of goods sold divided by inventory. In our case, our cost of goods sold from the income statement was 1,435,000,000, and then the inventory from the balance sheet 422 million, or 3.4 times. So, day sales in inventory, we just take 365 and divide it by the inventory turnover, or 3.4 times. So that tells us that we have 107 days in inventory. Again, the inventory turnover, and you would want and day sales. You compare those to prior year's competitor to get an idea of how efficiently the company is operating. 107 days could be high, could be normal. It just depends on the company and the industry. Receivables ratio. So first one of those is receivables turnover. They'll take sales and divide it by accounts receivable. So it gives you an idea of operating efficiency. Next we calculate days sales in receivables. So that's just 365 divided by receivables turnover that we so that's 365 divided by the 1229. So we have 29.69, or 30 days of sales and receivables. You want to pay attention to that. From year to year, the increases in day sales and receivables turnover, or increases in or decreases in receivables turnover could be an indication of potentially struggling clients or struggling business sector, so forth. So next we're going to calculate total asset turnover. We'll do that in the next lecture.